Welcome to today's Market Explainer. Let's dive right into a seriously fascinating chain reaction that just hit the global markets. We're going to break down the massive ripple effect caused across all major assets by a single, highly unexpected economic number. It's honestly a textbook example of how one single data point can just tip the first domino, sending massive momentum shifts straight through Forex, metals, and energy markets. If you want to understand what's actually driving your portfolio right now, well, you're in the exact right place. 57,000. Yeah, that was the actual figure from the June U.S. non-farm payrolls report. Now, the market was bracing for 110,000 new jobs, so coming in at nearly half of the forecast, that completely flipped the script. It forced the market to drastically reduce its expectations for short-term Fed rate hikes. Literally overnight, the whole narrative shifted from aggressive tightening to a much more cautious, dovish outlook for the Fed. And that fundamental shift, that was the first domino to fall. All right, here's our roadmap for today's explainer. First, the U.S. jobs shock. Second, the U.S. dollar loses momentum. Third, gold's spectacular breakout. Fourth, crude oil seeks momentum. And finally, next week's trends. Section 1. The U.S. jobs shock, the catalyst behind the market shift. Moving right along to Section 2. The U.S. dollar loses momentum. Tracking the dollar's stumble. You know how it goes. When expectations for rate hikes drop, the currency almost always takes a hit. The U.S. dollar index, the DXY, lost a full 1% over the span of just 2 trading sessions, tumbling all the way down to roughly 100.8 points. Now, in the currency world, a 1% drop in just 48 hours is a really sharp move. It clearly reflects how fast those aggressive rate hike expectations just evaporated. And in the Forex market, one currency's pain is literally another's gain. This broad US dollar weakness basically handed a massive opportunity to other major currencies. The British pound surged powerfully, actively outpacing both the euro and the Aussie dollar. The Japanese yen also improved significantly, gaining some much-needed ground as US bond yields finally began to cool off in response to that jobs data. So yeah, it was a broad, across-the-board retreat for the greenback. Section 3. Gold's spectacular breakout, the silent bottom and miraculous rise. So while the rest of the broader commodity sector was throwing off mixed signals, a little red here, a little green there, gold completely dominated this landscape. It absolutely thrived in the volatility, basically acting like a sponge for all that capital fleeing from the weakening US dollar. So what exactly fueled this silent bottoming and subsequent rise? Well, it boils down to 3 highly interconnected drivers. First, and we just touched on this, that broad weakness in the US dollar made gold way cheaper for international buyers. Second, expectations of a less hawkish Fed. Lower interest rates mean the opportunity cost of holding non-yielding assets like gold goes down. And third, sustained safe haven demand just kept a really firm floor under the price. Put those 3 forces together and they completely defied earlier market predictions that were actually calling for a much deeper drop in precious metals. Guys, the sheer magnitude of this breakout was wild. In a stunning reversal, gold hit a massive 5.9% growth margin by midweek. We saw spot prices push to roughly $4,175 an ounce, with COMEX futures reaching $4,190 before pulling back just slightly to close near $4,195. If you were holding short positions expecting that deeper drop, wow, this sudden surge was a major disruptor for sure. Section 4. Crude oil seeks momentum. A market stuck in a narrow range. Now, while gold was off to the races, those falling economic dominoes barely made a splash in crude oil. Brent crude is hovering right around $72 a barrel, while WTI is sitting near $69. The price action on both tells the exact same story. Hesitant, sideways movement. There is a total lack of clear upward or downward momentum. It's basically a market holding its breath. So why is oil stuck in the mud? It's basically a giant tug of war right now. On one side, you have support factors, lingering geopolitical risks, and OPEC Plus continuing their strict control over global supply. But pulling in the exact opposite direction, you have intense pressure factors. Progress in US-Iran talks is easing supply fears. We're seeing improved shipping traffic through the critical Strait of Hormuz, and overarching fears of slowing global demand. It is a perfectly balanced stalemate, preventing any kind of breakout. Section 5. Next week's trends. Actionable technical levels for traders. Okay, let's move from analysis to actionable intelligence. Here is your essential technical roadmap for the week ahead. For the US dollar index, the DXY, keep your eyes glued to the 100.6 point level. This is a crucial support zone. We are actually seeing buying pressure appear here, which opens up an optimistic view for resumed uptrend. For gold, after that massive surge, expect a short-term early week correction. Pay close attention to the $4,135 an ounce mark. This is being flagged as a major buying opportunity to re-enter the trend. And finally, for oil, expect a balanced rise initially, but be careful. Because of previous heavy selling pressure, there is a high risk of an opening gap before a potential deep drop. To tie this whole shebang together, there's a fantastic conclusion drawn straight from our sources. The overall picture shows the USD is currently the factor leading the entire commodities market. Everything we just looked at, from gold's strong recovery to oil's stubborn sideways stalemate weighed down by its own supply and demand pressures, all of it is fundamentally being driven by the engine of the US dollar's weakness. Which leaves us with the million-dollar question for the new trading week. Will the US dollar hold its critical 100.6 support level and bounce back? Or was that 57,000 jobs miss just the first signal of a massive, unstoppable commodity bull run? Keep your eyes on those charts, folks. Thank you so much for joining me for this explainer. Stay curious, stay structured, and I will see you next time.